Okay, so you see a dividend ETF, right? And you kind of think, this is going to be my solid, steady income generator, right?
Right.
But things are not always what they seem under the hood.
No, they're not.
And we're diving into that today with the Schwab U.S. Dividend Equity ETF, ticker SCHG.
Yes, we are.
Massive fund.
Huge.
I mean, over $77.5 billion in assets.
It's the second biggest in the dividend ETF world.
Yeah, and it recently got like a huge makeover.
Exactly, and this is what we're going to be talking about today. This deep dive is going to help us understand these major changes happening in SCHD.
Yes.
We're not talking about just like a little bit of spring cleaning here.
Yeah.
This is like a full-on renovation.
Total reshuffling.
It's all tied to the annual reconstitution of the Dow Jones U.S. Dividend 100 Index,
Right.
which SCHD follows.
It's a benchmark. Yep.
So if you're using SCHD for income or just curious about how these dividend-focused strategies stay on track, you're going to want to listen to this.
This is going to be insightful for sure. So this Dow Jones U.S. Dividend 100 Index, this is like the engine driving all of these changes. So what are the key things that it looks for in a company? What gets a company in?
Why?
And maybe even more importantly today, what gets a company kicked out?
That's a great question.
Yeah.
The index has a very specific and disciplined approach.
Okay.
And they're looking for companies that not only pay dividends, but also have the financial strength to keep paying them.
Right.
And also hopefully grow them over time.
Of course.
They use a quality-focused screen
Okay.
based on 4 major financial characteristics.
All right, so let's unpack those 4 crucial characteristics.
Sure.
What are we looking at here to determine if a company is worthy?
All right, so first off, they consider a company's cash flow to total debt.
Okay.
You can almost think about it like your own household budget.
Mm-hmm.
Do you have enough money coming in each month, your cash flow, to handle all your bills, which is your total debt?
Right, to comfortably cover it all. Yeah.
A healthy ratio suggests they have financial breathing room to continue those dividend payments, even when times get tough.
Right.
Second is the return on equity, or ROE.
Mm-hmm.
Now, this tells you how effectively a company is using the money invested by its shareholders to generate profit.
Right.
Higher ROE usually signals a more efficient and profitable business.
Makes sense.
The third factor is the indicated dividend yield, which is just the annual dividend payment as a percentage of the current stock price.
Mm-hmm.
And finally, the fourth is the 5-year dividend growth rate,
Okay.
showing the track record of how much the company has increased its dividend over the past 5 years.
So it's this combination of current income, so that's the yield,
Right.
and the underlying financial health and commitment to future increases.
Okay.
It's not just about today, it's about the future.
Exactly.
And you mentioned that they have to maintain these standards.
Right.
And I think that's key to understanding why we see companies kind of coming in and out each year, right? This annual reconstitution is crucial. It's where everything is reevaluated based on those metrics.
Yeah, every year the index managers, they take a fresh look at all the eligible companies and see how they stack up against these criteria.
Right.
And if a company slips below those standards in any of those areas, they're out.
Yeah.
And since SCHD tracks this index, those changes directly impact the ETF's holdings.
It is.
And this year, that meant 23 companies got the boot.
Whoa, 23. That's
a lot of turnover.
Yeah, that's a significant jump.
Yeah.
So let's dive into some of the names on the way out.
Sure.
One that really caught my eye was 3M ticker MMM.
Yep.
You know, it's a name everybody knows.
Household name.
Yeah, often thought of as like a classic dividend stock. So what happened? Why did they get kicked out?
But this really highlights the importance of that dividend growth criterion.
Okay.
3M. They had this amazing 64-year history of increasing their dividend.
Wow.
Which is like the holy grail for dividend investors.
It's like the dream.
Yeah. But then last May, they made a pretty dramatic cut to their quarterly dividend payment.
Oh.
They slashed it from $1.51 to 70 cents per share.
Whoa, that's a huge cut.
It is. Yeah.
So what drove that decision? I mean, 64 years they were doing so well.
Well, a few things were happening. They've been dealing with some hefty legal liabilities, and they also spun off their healthcare division, which created a separate company called Solventum.
Okay.
So these changes probably put a squeeze on their finances and their ability, or maybe even willingness, to keep up with that high level of dividend growth.
So even though they were a dividend aristocrat for over 6 decades,
Right.
that one cut just meant they no longer fit the bill.
Exactly.
It's kind of like hearing about, a legendary athlete and their record is finally broken.
Yeah,
It's going to happen someday, but it's still like a shock.
it is.
So 64-year streak broken, that's
That's a long time.
really shows how seriously this index takes the whole dividend growth thing. Another company that got removed, Broadcom, ticker AVGO.
Uh-huh.
This one seemed kind of strange to me because I know they've actually been increasing their dividend.
Yeah, they have.
So what was the story there?
Well, Broadcom's situation shows us that it's not all about dividend growth.
Okay.
Yield played the big part, too,
Right.
especially if you're trying to generate income.
Right.
So, yeah, Broadcom has been growing its dividend pretty well.
Uh-huh.
They had an 11% increase just last year,
Okay.
and that made their dividend growth streak 14 years long.
Wow. 14 years. That's a decent streak.
It is, but their stock price has also been going way up.
Okay, so how does a stock price jump affect their removal from a dividend ETF?
Well, because the dividend yield is calculated as the annual dividend divided by the stock price.
Right.
So when the stock price goes up a lot and the dividend doesn't increase at the same rate,
Uh-huh.
the yield goes down.
Okay.
So in Broadcom's case, their soaring stock prices dropped their dividend yield down to about 1.2%.
Mhm.
Now, to put that into perspective, the average yield of the S&P 500 is around 1.3%.
Mm-hmm.
But more importantly, the average yield of the stocks within the Dow Jones U.S. Dividend 100 Index is a lot higher.
Right.
It's around 3.5%.
So even though their dividend is growing,
Right.
that lower yield made them less appealing.
Exactly. They just weren't as attractive compared to other companies that meet that index's need for a strong dividend income stream.
That's really interesting. So even a growing dividend isn't enough if the yield is not competitive within that specific group.
Right.
Okay, so that's really important for anyone looking at dividend ETFs.
Definitely.
All right, so let's flip the script.
Sure.
23 companies were added to the index.
Yep.
And therefore added to SCHD.
Right.
What are some of the more interesting newcomers?
Well, one interesting addition is Vail Resorts, ticker MTN.
Okay, I know them. They run ski resorts, right?
They do.
Yeah.
And they currently have a pretty nice dividend yield of around 5.5%.
Whoa, 5.5%. That's pretty sweet in this environment.
It's a good one.
Yeah. What's their history like with dividends? Have they always been good?
They have a pretty solid track record.
Okay.
Like a lot of travel and hospitality companies, they had to pause their dividend during the pandemic.
Right.
But as things got better and their business bounced back,
Mm-hmm.
they brought back the dividend.
Okay.
And they've kept increasing it,
All right.
including an 8% increase last year.
So they really are committed to giving back to their shareholders.
They are. And that high current yield is definitely attractive for income investors.
Yeah, for sure. So a company that went through a really tough time,
Right.
brought the dividend back, and now showing strong yield, and they're growing again.
Exactly. Sounds like they check all the boxes.
Yeah, they do. What's another interesting addition?
Another one is Hershey Foods, ticker HSY.
Oh, yeah. Everyone loves their chocolate.
Everyone knows Hershey's.
Yeah, and they have a pretty sweet dividend too, right?
They do. It's
Yeah.
yielding around 3.3%.
Okay, so sweet dividend. I like that.
It's a good one.
So what about their dividend growth? What's their story?
They've got a good, strong, and consistent dividend growth record lately,
Okay.
including a 15% increase earlier this year at the beginning of 2024.
Wow. 15%. That's fantastic.
And get this, Hershey's has even said publicly they're going to keep growing their dividend as their earnings grow.
So they're really dedicated to rewarding their shareholders.
They are, which suggests a continuing focus on increasing dividend income in the future.
All right. So we've got a well-established, stable business.
Yep.
Decent current yield.
Uh-huh.
And a clear plan to keep those dividends going up.
That's Hershey's for you.
All right, so we've seen some big names like 3M and Broadcom leave SCHD, and some interesting new ones come in like Vail Resorts and Hershey.
Right.
So for someone who owns SCHD or is thinking about buying it, what's the main takeaway here?
Well, the core benefit is that you have this built-in system for maintaining a portfolio of what are considered to be high-quality dividend-paying stocks.
Right.
You don't have to spend time researching and picking 100 different dividend stocks on your own.
You're outsourcing that, yeah.
Exactly. The Dow Jones U.S. Dividend 100 Index, does that work for you using the criteria we talked about?
Right.
So you're basically outsourcing that work to the index.
Exactly.
And this annually reconstitution process is so important because it automatically removes companies that don't meet those high standards anymore.
Yep.
Like we saw with 3M with their dividend cut,
Mm.
or Broadcom where the yield became less attractive because the stock price went up.
Right, it got too pricey.
And then it replaces them with companies that have stronger dividend characteristics.
Like Vail Resorts?
Exactly.
Or Hershey?
Yep, both good examples.
So it's constantly checking for quality in the dividend stream you're aiming for.
Exactly. It's like quality control for your dividends.
I like that. So the goal is to ensure the portfolio sticks with companies that are not just paying dividends now, but are healthy enough to keep paying them and hopefully increase them in the future.
That's the idea.
So what does all of this tell me about how I should be looking at other dividend ETFs?
Well, it shows you how important it is to really understand the index and how it works.
Right. What's the methodology?
Exactly.
Okay, cool. The ultimate goal is for you to get a growing stream of passive dividend income.
Right.
Without having to analyze and pick individual stocks all the time.
Exactly. And this annual refresh helps make sure the ETF stays focused on that goal.
So this has been a really interesting look at SCHD.
It has.
Just to recap quickly, we've seen some pretty big changes in its holdings because of this annual index reconstitution.
We have.
Big names like 3M and Broadcom are gone for different reasons, but both tied back to the index's focus on both consistent dividend growth and a competitive yield.
Yep. That's a good summary.
And new companies like Vail Resorts and Hershey are in each one bringing something good to the table in terms of current yield and potential for dividend growth in the future.
Right.
So the key takeaway is that even something like a dividend ETF, which seems pretty stable,
Right.
is actively being adjusted behind the scenes because of this index tracking.
Exactly.
And that can lead to some big yearly changes.
It can.
So here's a final thought for everyone listening. Considering that even well-established dividend ETFs like SCHD are actively changing to keep up their quality, what does that tell us about what we think of as stable income investments?
A good question.
And what other things, beyond just looking at past performance or the current yield, should we be thinking about when we're evaluating these seemingly reliable parts of our portfolios?
It's a good reminder that even with dividends, things are always changing.
Right.
And it's worth doing a little digging.
Absolutely. Well, thanks for taking this deep dive with us.
My pleasure.
We'll see you next time.
See you later.
Bye.